Hi, this is Adam Khoo, and today I'm going to reveal to you the most important secret to investment success. Are you ready? Here it goes. The most important secret to making money consistently from the stock market is to buy low and sell high. It's to buy cheap and sell expensive. Now, I know you're thinking, yeah, easier said than done. How would I know when it's expensive or cheap? It can be really misleading at times in the stock market. For example, right now, Coca-Cola is selling at the price of $48. And Amazon is selling at $1,800. So does that mean that Amazon is more expensive than Coke, or Coke is cheaper than Amazon? No, in fact, I'm going to prove to you in a while that Amazon is really cheap at $1,800. And at $48, Coca-Cola is really expensive. And this was a lesson I learned about 11 years ago. About 11 years ago, there were two stocks that I bought. And the first stock was a stock called L&M, a construction company that was selling at 3 Singapore cents, 3 cents. And I bought another stock that was selling at $200 US. Let me tell you what stock that was. That was Google, also known as Alphabet today. Shortly after buying these two stocks, a couple of years later, L&M from 3 cents went to 0 cents. It went bankrupt. I lost everything that I put in. Thank God it was not a lot of money, right? And Google, I bought it at $200. It went to eventually over $1,000 per share. So you can see that looking back, L&M at 3 cents was really expensive, because the intrinsic value was 0, and it went to 0 because it was on the verge of bankruptcy. It was losing millions of dollars every single month. But at $200, Google was actually dirt cheap because it was worth a lot more money. And sure enough, it went to $1,000, and today it continues to go up. So there are two big mistakes that amateurs make, that beginners make. And the first mistake is that they look at the absolute price to determine if something's expensive or cheap. That's a big mistake, because something with an absolute price of 3 cents could be really expensive, and something with an absolute price of $200 or $1,800 could be really cheap. The second mistake that amateurs make is to look at PE ratio, known as price to earnings ratio, because many people think that, okay, the higher the PE ratio, the more expensive it is. The lower the P, the cheaper it is. Again, this is absolutely rubbish. For example, right now, Coca-Cola's PE ratio, price to earnings ratio, is about 30 times earnings. And Amazon has a PE ratio of 77 times earnings. And once again, amateurs will say, hey, this is cheap, this is expensive. And again, this is absolutely rubbish. I'm going to show you in a while that Amazon is actually really cheap at today's price, and Coca-Cola is really expensive. So to know if a stock is truly expensive or cheap, you have to calculate the stock's intrinsic value. What does that mean? It means, what is the stock really worth based on its assets, its debt, and how much cash it can generate over its lifetime. You see, when you buy a stock, what are you buying? You're buying a piece of a business. And a business is a money-making machine that will print money for many, many years to come. So how do you know how much this machine is worth? Well, the machine is worth the amount of money it's going to print over its lifetime, discounted to its present value. So let's look at an example of how you calculate the value of this money-making machine. So let's imagine that this is a timeline, and this is today, and that's a year from now, 2 years from now, 3 years from now. So if I've got a machine that prints money, and this machine prints $100 right now, right here today, what's this machine worth? Well, the machine will be worth, the value of the machine will be worth $100, right? Because if you buy the machine for $100, it prints $100, you get your money back. That's the value of the machine, okay? Now, what if you have got a machine that if you buy it today, you have to wait a year, wait 1 year to get $100? Will this machine then be worth $100 as well? No, it's going to be worth less than $100 because you have to wait 1 year to get your money back. So how much is this machine worth? Well, definitely less than $100. Okay, so it depends on your opportunity cost of your money. In other words, if you were to put your money somewhere else, what percentage return could you get from it? We call that the discount rate of money. So let's imagine you could invest in another investment with the same risk as this business at an interest rate of 5%. So that will be called the discount rate. Okay? So what you do is you take $100 that you're going to get in a year, divide it by 1 plus the discount rate, which is 5%. So that's 100 divided by 1.05, and you get $95. There you go. Okay? Simple math. Now, what if you've got a machine that you buy today, you have to wait 1 year, wait 2 years to get $100? What is this machine worth then? Again, it's going to be worth less than $100, and in fact, less than $95, because now you've got to wait 2 years to get your money. So you take $100 and divide it by 1 plus the discount rate, and you do that twice. So you square it. So you take $100 divided by 1.05 squared, you get $91. Got it? So the longer it takes to get your money, the less it is worth today. This is called the time value of money. Money received in the future is worth less than received today. So whatever money we get in the future, we have to discount it by that discount rate. Okay, final question. If I've got a machine that I buy today, it's going to print $100 right now. I get $100 today, another 100 in a year, another 100 in 2 years. What's the machine worth today? The answer will be $100 plus 95 plus 91. That will give me 286. So that's the value of the machine. Now, what has this got to do with a stock? Well, again, a stock is a business which is a money-making machine. So what you got to do is to figure out how much cash the entire business, for example, Amazon or Coca-Cola, is going to make over the next 10 years. Figure out how much cash it's going to generate, discount it to the present value. That will be the value of the whole company. And then divide it by the number of shares to get the value per share. That's it. That's how it's done. So we're going to show you how I do it right now on my intrinsic value calculator. So let me show you how I value the Amazon money-making machine. So just like the machine earlier on, we've got to figure out how much cash that the business is going to generate over its lifetime, and we're then going to discount it to its present value. Now, some analysts like to take a 20-year time frame, and some analysts like to take it to perpetuity, assuming the company is going to last forever. I'm really conservative. When I value a company, I just want to see how much money it's going to make for 10 years. That's it. Anything above that's a bonus. So in my intrinsic value calculator, I've got to find out how much cash it's making right now in the business. So some people ask me, why don't I take net profit? Because profit can be manipulated. It's an accounting entry. I prefer to take cash from operations, how much cash it actually generates from its business. And you can find this on any financial website. So I'm at Morningstar, and you can see that in the last financial year, Amazon generated, over here you can see, Amazon generated $37.23 million in net cash from operations. So that's the figure I want. I just plug it into the calculator over here. There you go, 37.23 million, or that's $30 billion. Next, I like to find out how much debt the company has, so I can calculate the debt per share. So Amazon has short-term plus long-term debt of $23 billion. Next, how much cash does it hold in its bank accounts and short-term investments, so I can calculate the cash per share. So Amazon, from the financial websites, has about $41 billion in cash. Next, really important, what is the growth rate of the company? So it makes $30 billion today. How much would it make next year, year after that, for the next 10 years? So we got to figure out the rough growth rate of the company based on analyst projections. So Amazon's a growth monster. And for example, on Reuters, you can see that for Amazon, okay, this is Amazon again, the growth rate projected for the long term, you can see over here, the long-term growth rate is 49.5% growth rate. Make it a bit bigger for you. There we go. 49.5% growth rate for the company. So I'm going to project a growth rate of 49.5%. Now, let's assume that the company can't grow at 49% for 10 years. That's going to be really difficult. So let's say for the first 5 years, it grows at 49%. The next 5 years, we cut it into half. It grows at 20%. Next, we have to figure out how many shares are there in total. So we divide by the number of shares, we know the value per share. So Amazon has 492 million shares outstanding. So you plug all this into the calculator, and the calculator will then kind of project. We call this the cash flow projection. How much money is going to make in 10 years, kind of like that machine printing money. So this year it makes 30 billion, next year 45 billion, 68 billion, 100 billion, and so on and so forth, projecting the money is going to make in the next 10 years. But we learned that money received in the future is worth less than money received today. So we have to apply the discount rate. So let's use a discount rate of 9%. Warren Buffett uses the risk-free rate or the long-term treasury bond as his discount rate, which is about 3%, which I think is a bit too low. I'm going to use 9% because of more risk in buying a business like Amazon. So based on a 9% discount rate, you can see over here, if you take the future cash flow, multiply by the discount factor, which is 1 divided by the discount rate, you get the discounted value of 42 million, 57 billion, 42 billion, like 79 billion. So it's kind of like the machine I talked earlier on, how we discount all that cash from $100 to $95, from 100 to 91. You get the picture, right? Okay, so that's what the calculator does. So if you add up all the discounted value, 1, 2, 3, 4, 5, you add up all the money the machine is going to make for the next 10 years, discounted to present value, add it all together, you get this figure over here, which is $1.44 trillion. So that's how much the whole Amazon machine is worth based on the money it's going to make. So you take 1.44 trillion divided by the number of shares, which is 492 million shares, you get an intrinsic value of $2,900 per share. So this tells you that one share of the Amazon machine is worth $2,900. But Amazon has got some debt, right? It's got 23 billion in debt. So if you take the total debt, divide by the number of shares, you get the debt per share of $47. So we have to deduct that as well. But Amazon has 41 billion in cash in the bank. So as a shareholder, you own that cash. So take all that cash, divide by number of shares, 41 billion, divide by 492 million, you get cash per share of $83. So the final intrinsic value of Amazon would be $2,900, which is the amount it's worth based on its earning power, minus the debt per share, $47, plus the cash per share, $83. You get, drum roll please, the final intrinsic value of $2,960. Ta-da! So that's how much Amazon is worth. So Amazon is worth $2,900, and it's currently selling at $1,800. So that's a big discount, right? So if I take my calculator and I take 1,800 divided by 2,900, that gives me about 38% discount. So Amazon is selling at a 38% discount to its true value. And that's why I've been buying Amazon, because it's really cheap. And recently at the Berkshire Hathaway annual meeting, Warren Buffett revealed that his company has been buying Amazon shares as well because it's really cheap. And now you know why. Now, some of you could be thinking, but Adam, what if 49% growth per year is too optimistic? Well, let's take a look at a bit of history. If you look at Amazon, you can see that for the last 5 years, it has been growing its earnings at 102% per year. So 49% growth is in fact being a bit pessimistic. We're assuming that their growth rate is dropping by half. Okay, but say you want to be conservative. In fact, on FinViz, they project that Amazon is going to grow at 40% and not 49%. So you can look at several websites and you can take the most conservative figure. FinViz has been one of the most conservative figures. So even if you take 40% instead of 49%, if you plug that into 40% over here, boom, you get $2,200, which is still higher than the current price of $1,800. So no doubt Amazon is a really cheap company at $1,800. So how about Coca-Cola? Is it expensive or cheap? Currently, Coke shares are selling at $48 per share. Now let's take a look at some figures over here. In the last 5 years, Coca-Cola has been declining at 3.9%. In fact, its sales and profits have been going down. But let's assume it's temporary and it's going to increase. It's going to be growing in the future. And it's projected to grow at only 5.11% in the next 5 years. That's the long-term growth rate of Coca-Cola. And Coke has 4.26 billion shares, or 4,260 million shares. If you take a look at its cash flow, you saw that Amazon made $30 billion a year in cash. And for Coke, it made, in the last financial year, $7 billion. So first of all, you can see Coke made only $7 billion compared to $30 billion for Amazon. And Amazon has only 400 million shares issued, but Coke has 4 billion shares being issued. So based on that, let's go to our calculator and let's look at the numbers. Okay, so that we have for Coke. So we plug in the numbers. Coke is making currently $7 billion in cash flow. Coke has total debt, short-term plus long-term debt, of $44 billion in debt. It has $11.9 billion of cash and short-term investments, and it's growing only at 5%. And it has 4.26 billion shares. So if you put in all these numbers, you can see that the total value of the whole company of Coca-Cola is worth $76 billion. And that's how much it is worth based on the money it's generating. So if you take $76 billion divided by the number of shares, the intrinsic value per share, it's only $18. It's only worth $18. Okay. Now, if you deduct the debt per share, because it's got a huge amount of debt, if you deduct $10 of debt per share and you add $10 of cash, or you add $2.80 of cash per share, your final intrinsic value is only $10.42, which means Coca-Cola, if you think about it, if you look at the debt and its assets and its cash, is only worth $10 a share. So at the current share price of $48, I think it's really expensive. It's really overvalued. Now, some people may be saying to me, Adam, I think you're being too conservative because you're only projecting a 10-year lifespan for the company. But, Coke's going to last 20 years or 30 years. Fine. So even if you take 20 or 30-year lifespan, so what you could do is you could take $10, all right, multiply it by 3 times, because 30 years instead of 10 years, and that will give you an intrinsic value of $30, which is still much lower than the $48 price it's selling at right now. Now, some of you could be then saying to me, but Adam, maybe don't take the debt. The debt is $10. Let's assume that their debt is forgiven, right? So if you add back the debt, okay, add back $10 to the debt, that's still $40 per share. And I know I'm doing my best to kind of like manipulate the figures as much as I can, but no matter how I do it, I can't justify a $48 price on Coca-Cola. So you can see that a $48 stock can be really expensive and a $1,800 stock can be really cheap. And so that's my secret of making money consistently for the last 20 years in the stock market, by valuing the company, buying cheap, holding till it's expensive, or selling when it's really expensive. And that's how you make money in the stock market. Now, of course, you can't just look at valuation. You can't just look at intrinsic value. In my value momentum investing course, where you'll be getting this calculator, I'll also teach you the 8 steps of how to identify a great company, how do you buy at a discount, and also to look at the trend of the stock. You have to look at technical analysis and buy only on a clear uptrend or at support levels. Because even though something is cheap, cheap could get cheaper, low could get lower. So buy undervalued with uptrend momentum. So I call it value momentum investing. And that has been my secret of generating profits from the stock market. If you want to learn more, find out more in my next few videos, as well as coming to the Value Momentum Investing course or the Wealth Academy live program that I run in Singapore. Take care. I'll see you in the next video. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.